Hi, this is Utkarsh Jain and we are on to CFA Level I, Reading 39, Dividends and Share Repurchases. The first major point of discussion is about the regular cash dividends, extra dividends, stock splits, reverse stock splits, and the effect on the shareholders' wealth and the company's financial ratios. Now, you can write down this particular flow chart and then we can discuss about it. Okay, let's understand what it means now. The first dividend is regular, and this is being called regular because there would be something which is non-regular, which is being called as special. So again, in Indian context, this regular can further be divided into two parts, though not required for your exams. That a regular dividend, which is something which is paid every year, can either be, or in fact at times it's both. It might be called as interim dividend or final dividend, not required for your exams. So what is interim dividend? The way it happens in India is that there would be a meeting called as annual general meeting, which would happen once in a year. And in this particular meeting, shareholders would decide that what is the amount of dividend that is to be generally paid. Now, this meeting happens once in a year. So in between this period, if a company feels that some amount of dividend is to be paid, right, and they cannot wait for AGM to pay that dividend. So in the meanwhile, subject to certain restrictions, they can pay some amount of dividend, and that dividend is called as interim dividend, and the dividend which is approved in the final meeting in AGM would be called as final dividend. Now see, what this special means is, let us say that a company has been consistently paying a dividend of 30, 32, 35 rupees for the last 3 years. Now in this year, company has made sales of one of their sales assets, and now because of which they have a very huge amount of cash flow. So let's say that they can now afford to pay a dividend of 100 rupees in this particular year. But the problem is that if you pay 100 here and next year if you pay 30, then your shareholders would look at it as a negative signal. They would say that dividend come ho gaya. So what do? You still pay 100, but you say that out of this 100, 30 or 35 is the regular dividend, and this 65 is bonus dividend, or this is special dividend. So please do not expect it next year. So the impact of this is that the expectations of shareholders would not be raised, which is called a special, which is paid once in a while. And liquidating, of course, in case if the Kingfisher now decides to pay dividend, that would be liquidating dividend, though which is very unlikely if they would pay anything. But in case if they do, that means company decided to sell off the business, take all the assets, and whatever cash that you generate, distribute to that to shareholders, which is called as liquidating dividend. Okay. Now, cash dividend reduces the value of company's asset. Fairly intuitive, because that amount of cash is now gone. And if the amount of cash is gone, looking at it from a balance sheet perspective, can I say that book value of share will reduce? Can I say that when cash dividend is paid, book value per share will reduce? Yes or no? Yes, because what is your book value per share? Total of assets minus liability. So if your assets are reducing, automatically book value per share will reduce. And the same reason that, what generally people think is that when you pay dividend, stock price increases. But it's in fact, from a logical perspective, the other way around. That when you pay dividend, it should reduce the market value of your equity. This is making sense. And why would that happen? Think of a share as a big pie. Okay. So if your share is made of this pie, if cash dividend is paid to you, what it means is that some part of this share is being converted into cash and given to you separately. So if the value of your stock was 100 rupees, and if the amount of dividend which is being paid to you is 20, after the dividend is being paid, or generally we have a date called as X dividend date, that after this date, price of the stock theoretically should be how much? 80. Are we clear with this? So when dividend is paid, what it means is, think of a big piece of land and the value of this land is appreciating. So if you sell some part of that land, that means you have some amount of cash, but the value of land is now relatively lesser. Same is the logic with shares. That if some amount of dividend is given to you, you have that cash, but price of the share will reduce in the market. So it reduces market value of equity. it will decrease liquidity ratio, and liquidity ratio is current ratio, which is current assets divided by current liability, or quick ratio, which is current assets minus inventory divided by current liability. So again, if you are paying dividend, your cash is going to reduce, and therefore both of your liquidity ratios will reduce. It increases the leverage ratio. Can anyone tell me why? Why would dividend increase your leverage ratios? Vivek? And when you pay dividend, will your equity reduce? Because you are paying dividend out of your earnings, your equity will reduce, and leverage ratio can be simply thought of debt divided by equity. So if your equity reduces, automatically this leverage ratio is going to increase. Stock dividends, we've already seen this part, we call this as bonus shares, distributions of new shares rather than cash. So again, think of it this way, this is the balance sheet of a company. Let's say we have this equity share capital of 10 lakhs and we have reserves of another 15 lakhs, and then we have some amount of assets here. Let's say assets are 30 and we have bank loan of 15 lakhs. So 30 and 30. Now, if the company decided that some part of these reserves I want to give to the shareholders, if they decide that I want to give that in the form of cash, so let's assume scenario number 1 that this was to be given in the form of cash, then it would be called as a cash dividend. And let's say if the amount is 5 lakhs, what will happen is that these reserves will now become 10, and since 5 lakh worth of cash has been given, your assets will now be 25. So again, the total on both the sides, did I do this total correctly? This should have been 40. And this should have been 40 originally. So then this would become 35. Making sense? Now let's revert back. Let's say this is again 15 and this is again 40. Now company decided that no, I do not want to pay this dividend in cash. I want to pay this dividend in stocks. Then what company is going to do is that reserves are still going to reduce, but instead of giving you cash, they will give you stocks. So now reserves would be 10 lakhs, but the equity share now would be 15 lakhs. Nothing happened on the asset side. That simply, this is also called as capitalization of your reserves. That simply you take some part of that reserves and you give it to the shareholder in the form of fresh equity shares. Are we clear? Which is called as bonus shares. Stock splits, dividing one stock into various small multiple parts. Both of these create more shares, but there is a proportionate drop in the price per share, so there is no effect on total value of shareholders' wealth. So again, what it means is that let's say you have one share of 100 rupees. If the company decided to split this and split one share into two parts, now you will have two shares, but price per share will be 50. So again, your total wealth is 100. Company decided that to give bonus share and give one share for one share free. So again, now you have two shares, but price per share is 50, and again the total wealth to the shareholder is 100. That means the net impact as far as shareholders' wealth is concerned is going to be same, whether it's a stock split or it's a bonus share. But of course, from an accounting perspective, stock split does not change your balance sheet in any way apart from the disclosure. Whereas in case of bonus share, there is a small change on the balance sheet. Some amount from reserves is transferred to your equity share capital. Answer this question. Yes, the answer is B. That if we saw this stock Orissa Minerals, which was trading at about 90 odd Orissa Minerals, which was trading at about 90 odd thousand, that was being split, so that now it is more into a trading range. Now, in case if CFA Institute decides that let's put certain questions, and if a student answers that question incorrectly, let's fail him. This is one of the questions. So if you answer this as C, reply to the request made as shareholders, then your chances are really weak in this particular exam. So which is very unlikely. stock dividends. This B option is meaningless. This should be cash dividends. No, this should be in fact stock splits. Then it would make sense. Now answer. What is the answer? Okay, please remember that the answer is A, okay, which means A is correct, which means B and C are incorrect. So think of it this way, that stock split is something which is relatively easier to do, okay, because there are not a very strong regulatory framework which is surrounding it. So stock split should not be very difficult, but if you have to give bonus shares, since we saw that there was an accounting entry, you need to have that level of reserves. Okay. So different countries will have different set of laws, but relatively stock split is something which is more common and bonus shares are relatively uncommon. And of course it does not affect firm value, so this was irrelevant. It affects the share value, but it does not affect the overall firm value. Now this is an interesting LOS. It says dividend payment chronology. So you can make this timeline. We will discuss what it means. Write down declaration date. Then there are two date slots in between. Holder of record date and payment date. Are you done? See, understand this carefully. You can expect, there's a good chance you might get at least a question from this particular slide. So it's a popular area. What it means is, let's say that dividend was declared on 1st of Jan. So not necessary that the dividend, the day on which dividend is declared, on the same day dividend would be paid. So this 1st of Jan would be called as declaration date. And then with every dividend, there would be a holder of record date attached. Okay, so let's say that company has declared that to be 15th of Jan. Now, you would ask, is there is logic between having the window of 15 days in between? No, it would be dependent on the corporate laws of each and every country. Okay, but that logic we don't have to worry about. That means what would be the difference between declaration date and holder of record date? We don't worry about it too much. And payment date might again be, let's say, 18th or 19th. So again, there is no logic. So what does it mean? Every company maintains a register, okay, or they maintain a book or a record, and in this book they write down the list of shareholders. Now tell me that you purchase, let's say that you go on to Nifty and you decide that you would purchase one of the, you go on to NSE and you purchase Infosys share. So the moment you purchase, because these days we trade on dematerialized share, does your name go on to the whole register of the company? My question is that at 9:30 you went on to your portal and you purchased one Infosys share. Will your name directly go into the share, the register of company that it maintains, a company maintains, where they write down the list of shareholders? It would not. Then there is something called a settlement cycle that exists in each and every country. So in India, that settlement cycle is of 2 days, but you don't write this. In India, settlement cycle is 2 days, but for your exam perspective, we have to worry about US settlement cycle, and US settlement cycle is 3 days. So what does it mean? If you purchase a share on 1st, it would take them 3 days to do that processing, so that your name would be registered into that share register of the company on 4th. Is this clear? That it would take 3 days from the date of purchase to go into the register of company. So now the problem is that all those people whose name is there in this register on 15th, those people would be eligible to receive dividend on 18th. This is the meaning of holder of record date. That all those shareholders whose name is in my register on 15th, only those people would receive cash dividend on 18th. So the question is, if I have to receive dividend on 15th and I know that it takes 3 days to get your name into the list of register or list of shareholders, then you should purchase a share on 12th. So that you purchase the share on 12th and then 13th, 14th and on 15th your name would be there on the register of shareholders. So now this 12th you can write down is the last date. 12th is the last date to purchase share. 12th is the last date to purchase share if shareholder wants to receive dividend. So in this case, 12th is the last date to purchase share if the shareholder wants to receive dividend, and this is 3 transaction date before the holder of record date. So you can write down 15th minus 3 days. So it is 15th minus 3 days. Why? Because the settlement cycle is of 3 days. And if you buy a share and you also have a right to receive dividend, it is called as cum dividend. So you can also write down that 12th in this example, of course, please don't remember the dates. 12th is the last date on which share trades cum dividend. Cum dividend, CUM. So cum means that it would trade along with the dividend. Which means that if someone buys the share on 13th, his name will go into the list of shareholders on 16th and then he wouldn't receive the dividend, isn't it? So 13th is the first day on which the share becomes ex-dividend. That means if you buy the share on 13th, you would not have a right to receive that dividend. Therefore, the ex-dividend date is 2 business days before the holder of record date. So this is the logic behind these 2 days. Are you clear? So 13th here would be called as ex-dividend date. Two
years to get dividends. Is it 2 days?
2 days. 2 days. Yes. 2 transaction days. Are you clear with this? Now, so as far as your exams are concerned, you need to remember in US settlement cycle is 3 days and therefore ex-dividend date is 2 days prior to the holder of record date. So it's a thumb rule. So simply remember this 2 as a number. Just be careful, this is for ex-dividend. So if they ask you what is the last day on which the stock would become dividend, it would be 3 days. 15 minus 3. Now, if the stock was trading, let's say at about 100 rupees here, what will happen is if someone buys the stock on 12th, he will actually get to buy the stock at 100 rupees. But on 13th, the price of the stock will become 80, assuming a dividend of 20. On ex-dividend date, the price of a stock will theoretically fall by the amount of dividend. And that makes sense because see, let's say on 12th, you know that this is the last cum dividend date. So you buy the share on 12th for 100 rupees. What you do is that on 13th, you actually sell that share. But what will happen is that since you were the owner of the share at the end of 12th, on 15th, your name will go into the register of shareholders. The person who purchased from you, his name will go into the register of shareholders on 16th. That means even though you buy the share on 12th, if you sell it on 30th, you still receive the dividend. As long as your share was there with you by the end of 12th. Have you followed this? So what someone might do is that he would buy the share at 100 here. If he sells the share at 100 on 13th, what his benefit is, he also receives 20 rupees as dividend. That means within one day, he is making 20%. And if this is true, then probably instead of studying here, all of us should be doing only this thing. Right? That there are companies and we should be throughout the year earning this 20% on every dividend. So it does not happen that way. What happens is that on this day, the price of the stock will become 80. So you buy the share at 100, the day it becomes ex-dividend, the price reduces by 80 and then you receive dividend of 20, so it's still 100. Are you clear with the logic? And that is the reason why theoretically, I am saying this theoretically because in real life things not necessarily behave exactly in the same fashion. But as far as exams are concerned, that the day stocks become ex-dividend, the price of the stock will reduce by the amount of dividend. Okay, so this was cum dividend, this is ex-dividend. That's an interesting name, Martin. How many of you think A? Please raise your hands. How many of you think A? How many of you think B? How many of you think C? The answer here is A. Again, the intuition is straightforward. That let's say this is the ex-dividend date. Okay, so let's call this as 2, which means that cum dividend date must have been here. It must have been a day before that or all the days before that. Now he sold the shares and let's say this is holder of record date, which is, since this is 2, this would be 4. So he sold his shares between 2nd and 4th, which means that he was holding the share on 1st, which means that he is eligible to receive dividend. So please remember that as long as you have the share on, if the date of dividend is 15th, as long as you are the owner of the share by the end of 12th, then you are going to receive dividend. So it does not matter what you do with that share after that day. Which means technically when the dividend is paid, even if you do not have that share with you, you still receive the dividend. Are we clear with this logic?